Week 131. In case you're new here, you don't know what I mean when I say week 131. I am the only real estate broker, the only real estate team, the spring team, that has been tracking the market for 131 weeks in a row since COVID began March of 2020. Why is that important? Well, it's important because our markets move fast right now. They've been moving faster for the past few years. And if you're relying on information released by the Toronto Regional Real Estate Board at the end of every month, then the data is old. It's not necessarily reflective of what's happening in the market today, which is why I decided to start reporting weekly in March of 2020 to make sure originally that our clients were kept informed, but then the readership of this blog grew to the point where we have over 50,000 weekly readers now. I felt like it was really, really important to get this information out weekly and more, which remains more current and keeps people that are looking to sell properties in the areas that we generally transact, keeps them in the loop. If you're reading information about that comes out of the Toronto Regional Real Estate Board, it's usually incredibly broad. You're looking at information that is talking about the 416, the 905, the GTA. It's just too much. It's too broad an area. If you tell me that prices are down 20% in the GTA, but I have a house in High Park, for example, that's not necessarily reflective of what's happening with my property in High Park, despite what's happening in the greater region. And let alone, forget about GTA. There's some statistics that are really only talking about Canada in general, and we don't really care about that national or regional or a general, area code specific information. We need very specific information for the areas that our clients usually transact in. And typically that's south of the 401. That's from Mississauga all the way to the, Pickering and into Durham, which we're going to start reporting on next week. So these areas are what matter to us, and these are the areas that I'm talking about with you. So what's going on this week in week 131 that just passed? Not a ton, to be honest. It's the last week of summer, and let's not forget, if you haven't been a realtor that's been around for a few years, previously, there used to be seasons that were busier than other seasons. This summer season acted like a normal summer season. A lot of people, of course, you can blame the interest rates or whatever it is. And of course, that had a lot to do with removing buyers from the market and calming things down. But overall, this summer was a normal summer, as you would expect. However, I was going to move this market report from this week to next, or sorry, from today, Tuesday this week, to tomorrow, because as we all know, September the 7th is the next Bank of Canada announcement. Now, if you saw the video, read the blog last week, it's linked in this post here so you can see it. A lot of realtors seem to have only read the headlines. And these headlines said that their CIBC strategist it said rate hike cycle to end. Next Bank of Canada announcement, and they were citing this CIBC strategist. If you read that article further, and I'm not going to repeat myself here, you can just go back and see the other video, you'll see that number one, a hike to the cycle didn't mean that there wasn't going to be a rate hike tomorrow. There is going to be a rate hike tomorrow. Most people believe it will be 0.75%. Unclear. We've been surprised before. We'll be surprised again. I don't think we'll be surprised by a 1% increase or something like that this time, only because inflation has pulled back for 1 month now. So if we get a few more months of inflation pulling back, then obviously we will see some pullback in the rates as well. But right now, 0.75% increase tomorrow. That is one part of the news. The most important part of the news, and I don't know why people think they're so confident in that Bank of Canada is going to somehow halt this hike cycle. It's not reasonable. It's probably not going to happen. And inflation is nowhere near where the federal government would like it to be. So I really don't see them putting an end to the hikes. What I do see them putting an end to are those surprise aggressive hikes. So 0.75 is what's expected. We should have a 0.75 tomorrow, but I'm going to make another video. I might do 2 market reports this week. You get this one and you're going to get the one tomorrow. We'll see how that rolls out. But my real focus this week is going to be, let me get the blog open for you so you guys can see right here. So where have all the listings gone is what I'm talking about. This is a, like I said before, one of the main reasons why the Toronto's urban markets haven't really crashed like some real estate bears would like you to believe is because inventory has been consistently pulling back, with the most aggressive pullback this past week. To go into some actual numbers here, and we can see the chart how we've been performing since I started tracking back in March, and I have all these data points individually out there as well for you to share with you. Just reach out to me and I'll share them with you. 416 active listings. These are in terms of houses, and this is in our urban markets. So we're talking urban markets like, the border of Etobicoke, Toronto, to Victoria Park where the beaches starts, Danforth, Bloor, down to the lake. Like this was up to 625 about 6 weeks ago, and we're down over 200 units. That's a big drop. Sales are down, but that's expected for the last week of summer. I don't know where you were at, but I was at a cottage this weekend. I wasn't even thinking about selling real estate this weekend. Months of inventory down from 1.54. And if months of inventory is confusing to you, don't be. It's very simple. If there were no new listings added to market, it would take 1.3 months to sell everything at the current rate of sales. So a healthy buyer's market is like closer to 3 months of inventory, and an aggressive seller's market is generally this area. Like we were operating in the point, under 1 month of inventory during January and February, which was essentially the peak of the market. But in any normal market, when buyers are out en masse, this would be an aggressive seller's market. Normally, with this kind of months of inventory statistic, we would have multiple offers on every single property that's out there right now. But we are not having that. Why? Because buyers have removed themselves from the market. Number one, they were forced out because of the past interest rate increases. Number two, they're sitting on the sidelines waiting to see what's going to happen. We'll talk about that whole wait and see attitude later. It makes sense for some, but generally it doesn't make sense for the reason that some buyers are telling us they're doing it. If you're going to wait and see what happens to the market, you're letting that day trader mentality creep in a little bit. If you're waiting and see because you think interest rates are going to go up, what does that mean to the prices? If you're waiting to see, then you'd better make sure you have a mortgage pre-approval that takes you a couple of months beyond the next rate hike, because you might be approved for a mortgage today, but you need to close on that mortgage. You need to close on that property before the rates change for you again. So there's a lot that needs to happen here in order for that wait and strategy to make sense. Generally, it doesn't, especially if you are looking for something very specific that may not be on the market then if it is now. If you're looking for something very specific, that needle in the haystack type property, and it becomes available today, and you're waiting to see if it becomes cheaper for you down the road, like it's not a reasonable expectation that that type of needle in the haystack property will be available for you again when you feel like you're ready to jump in. So supply now is super low, and we've talked about this many, many times, but this is lower than I expected it to be at this time. Normally on a day like this, the first day back, the opening of the fall market, so to speak, fall doesn't start until the 22nd of September, but the opening of the fall market is essentially now. We have a flood of listings, but that's not happening today as of Tuesday, 2 p.m. anyway. And you'll notice that condo average prices are still doing, what they've been doing. If we look back at this chart, there is, some ups and downs, of course, but you see houses fluctuating a lot more than condos did. So condos have been very stable throughout this whole process. Dip in the median, which is a really important figure to consider, because that usually would suggest, if it trends this way, that the middle of the market is moving down. That means prices are moving down, but that's not really true, not reflective of what we're seeing out there in the marketplace, mainly because of, again, we've had inventory come down almost 700 units in 6 to 7 weeks. That's a tremendous amount of listings being removed from the market. Again, proving that we do not have panic sellers. And months of inventory down to 1.78 from 2.02, which was down from 2.4 the previous month. So there's been a tremendous amount of pullback in supply. So any little thing right now that sparks buyer interest, anything that gets buyers excited right now, like we could go from this type of more balanced / buyer's market in some cases to an aggressive seller's market like that right now. Like for example, let me get my big face on camera here so you have to look at my screen. For example, if tomorrow, for some reason, the Bank of Canada decides to go against the US Fed and halt these hikes, the market is going to absolutely pop off in Toronto. Like, it is going to be another generational run up if there is a hike tomorrow. Again, I don't think, sorry, if there's a halt tomorrow. I really don't think that that's going to happen, because it would be terribly irresponsible to set the market off again right now with inflation being where it is. And which is why I really need people out there. If you're one of those people that believe that there's going to be a halt to this tomorrow, like, you just need to stop spewing that nonsense, because it just doesn't make any sense for our economy, for anybody. We have, shown some strength, but really the reason that inflation came down a little bit was because of gas prices coming down. Everything else is still expensive as hell. So a lot of control still. We're heading into a recession, so if not in one already. So let's just not get our hopes up about that right there. But we're in a market right now where if you're a buyer, especially a buyer looking for something specific, just buy it and just lock in and move on. You know what I mean? So anyway, so that's pretty much what's going on right now. I didn't put too much weight into this particular update because I'm going to do a longer one after the announcement, just so we get some feedback from our mortgage professionals and some clients and see how they feel about it. But generally, if any of the previous unprecedented events are to teach us something, it teaches us that we do not have over-leveraged panic sellers en masse here in Toronto's urban markets and surrounding communities. They haven't proven themselves to be there before, and I really don't think they're going to be there now. There are concerns with, as rates increase, them triggering higher payments for some people. Those higher payments are due to the rates increasing so much so that they're no longer covering any of the principal and only covering the interest portion of the mortgage. And if they increase any more, there won't even be enough to cover the interest portion. So that would trigger an adjustment in the mortgage payment. So these kinds of triggers do exist in the marketplace, and they will certainly affect some borrowers. But in Toronto, it doesn't seem to be, or it's not going to be affecting enough borrowers that people have to all of a sudden fire sale their properties. So we will see how the next few months play out. But in my opinion, I believe that the next few months, as we head into the holiday season of 2022, aka the end of the year of 2022, I think it's going to be a fairly slow real estate market, with properties selling as they have been, some in multiple offers, some not. There are going to be even more buyers removed from the marketplace with the hike announcement tomorrow. Whether it's halted or not, there's still going to be a hike tomorrow of 0.75%. So that's going to remove some buyers from the market, further fueling, number one, either those buyers are either going to chill and not do anything, or those buyers are going to go into the rental market if they need to move. So, we've learned so far that the rental market was not just driven by students and international students, whoever it may be, looking for spaces ahead of the school year, because the rental market is still popping off right now. And that is also going to be driven by, sorry, that was my phone right there. That is also going to be driven by these buyers who can no longer afford to buy. So it's kind of where we're at right now. But I'm going to keep this week's relatively short. 13 minutes, you consider that short or not. I'll leave you with one question. Do you think that the bottom of our market is behind us? Or do you think that there is more bottom ahead, so to speak? We can all agree that the top was January, February. Have we seen the bottom? Or is there more? I don't know. Comment below, we'll talk about it. Look out for a next video, either tomorrow or the day after, about the interest rate announcement that's coming. And I will see you soon. Thanks so much for your attention. Love you all. Please subscribe. Bye-bye.